My name is Adeo Ressi. I'm CEO of VC Lab. I'm joined here today, a little late, but not never, with Jason Calacanis.
It'll be worth the wait.
Fault.
I'll make it worth the wait.
Jason, lovely to have you. We've known each other since like 94, 95, and gotten way, way back. So I've seen Jason from being an editor, publisher, all the way through to today, where he's prolific investor and pundit on the whole startup ecosystem. So it's been quite a journey from humble beginnings to where you are today.
For both of us.
Yeah, for both of us, it's been a beautiful journey.
You're a website builder.
And so, while we're debugging and having people stream in, what like, it's been a journey from you from these humble beginnings to this really privileged position in the world today, where you can comment on the things that are happening. You can invest in some of the most interesting companies out there. Now, why don't we just take a moment and talk about that journey? Is there anything that you'd like to share about the lessons learned from that and staying humble throughout?
Yeah. It's been quite a journey. We were both born at the right time, you and I, being born in the 70s and getting to watch the PC revolution up close and personal, and then the internet revolution. So I do believe timing really was favorable for both of us in our careers. I was born in 1970. I think you're a year younger than me. So
72.
You were 72. So you're 2 years younger than me. And so sometime in the late 70s and 80s, we got to see PCs appear, maybe get exposed to TSR-80s and VC Calc and the first couple of spreadsheets. And then when we went to college, we probably saw BitNet and ARPANET, which eventually, when we graduated with college, became the World Wide Web with the Netscape browser and Mosaic before that. And you and I started our careers basically at that exact time. What timing, right? To watch both of those revolutions occur. And then adding to that, we got to watch, the internet go into broadband, which was kind of a distinctly different experience than the dial-up internet. So I kind of break those into two, because once the ubiquity of broadband happened, it opened up a lot of different things that weren't possible previously. And then, of course, smartphone revolution. And now here we are with either the crypto or augmented reality,
Meta,
whatever. So you get to ride certain waves, and obviously people who are coming into the industry now will be riding, synthetic biology, AR, and crypto possibly, and then whatever comes after that could be really interesting as well. So I've always felt like you need to be surfing on the beach where the biggest waves are, the best waves are, and that is what we got to do in our lifetimes. And
it seems like there are more and more waves coming, right? We brought up Meta, right? Mm-hmm. And I know they're debugging the attendance thing right now. So this will be recorded. So worst case scenario, we'll send it out to everyone who registered and they can watch it virtually. But so there are waves that are continuing to come, and it seems like, mobile wasn't all that long ago, and then you had social, and now you have this next wave with crypto. And in fact, I would argue there's even multiple waves happening at the same time. And you brought up crypto.
Set of waves, right? It's a set of waves, right? I think that's a nice analogy, is like, you look at what happened with the web, it was a set of waves that occurred, from dial-up to shitty browsers to elegant web browsers, peer-to-peer software, broadband occurred. All these things were a series of waves that you could ride. Web 2.0, Ajax, dynamic websites, mobile websites. So my point in all of that is, you get to identify these trends, and if you can identify them and get in on them early, you will look really smart later. And I think that's just basically the story of both of our careers. You were building websites when people didn't know how to set up their internet connections. So, while people were futzing with PPP and TCP on their Macs and trying to get, just get their web browser to work, you were building the websites, right? And I was lucky to be investing in great companies as an angel investor before VC Lab or Angel List or other things existed. So I got in early on angel investing, and obviously that worked out pretty well.
One of the first things I wanted to talk to you about is what's going on in the world of entrepreneurship and finance, because in many places around the world, companies are getting traction and they're getting big valuations, and not a lot of people are punditizing it like, oh, it's bad, it's good. And like, I'd love to hear your considered view of what this all means. Is it a good thing, a bad thing, et cetera? Let's jump right in with that question.
Sure. So never been a better time to be an entrepreneur. Ton of problems to solve in the world. Not sure I can say the same about being an investor because there are so many investors, and VC Lab is an attempt to create even more. So one of the challenges in the world right now is there are so many capital allocators trying to put money to work, and they're trying to look for returns. And most people believe the stock market is fully valued, therefore buying shares of Amazon or Apple. How much bigger can they get if they've run up this far? The number of publicly traded companies is roughly half of where it was at the peak. We're getting more supply out there as we have SPACs and IPOs, direct listings, et cetera. And so there's a lot of capital chasing a small number of deals. One of the things that capital has realized is, maybe we should invest in startups earlier. And so we've seen this movie before, where new money comes into the industry, whether it was Yuri Milner at one point and Russian money coming in, Japanese money with Masayoshi-san, and Saudi money coming in and giving high valuations to companies with SoftBank's Vision Fund. This is something that happens every 5 or 10 years when the industry gets heated up. So we're at an all-time high. It's peak valuations. It's peak madness. Nothing makes a lot of sense according to classic valuation metrics. And so when I invested in this company, it was a $4.5 million company, and you can put a 25 or 50K check in and have it turn into 9 figures. And now companies that have done less than Uber, Thumbtack, and some of the other great companies I've been lucky enough to invest in, Robinhood, are being valued at 50 million before they're even launched, 30, 40, 50 million. So you're paying 10 times as much for a company that's done, 1/20th of what companies were doing just 10 years ago. That's pretty bad deal. Great deal for the founders, obviously, but a really, really challenging deal for investors, because the majority of startups do fail. And that's what we want. We want startups to fail because they try to be audacious. In my estimation, pre-product market fit startups, when you invest in them, you should expect 80% to go to zero, maybe 90%. Pre-product market fit. In other words, they don't have customers yet. When they have customers, maybe expect 2 out of 3 to die, 60, 70% to go to zero. And so you have a really high mortality rate, and these high prices, then you would need to have a commensurate exit with that. Now that can happen, but it's very rare. So I do think that the equation of buying low and selling high has been broken now. People are buying high, and I think that they might wind up selling low, or they're going to have a hard time showing the returns that venture classically had if they're investing at this point in this vintage of companies. It's going to be challenging.
Yeah. So like occasionally I might chime in, because some of the
Sure,
things
yeah, of course, do it.
are really,
let's make it a
really
discussion. Yeah, interrupt.
awesome. So, okay. And for everyone out there, if you put a question in the Q&A, we'll try and get to it in the latter half of the conversation. Hopefully Jason can stay a little late because we had the mix up. And upvote your questions, and we'll do the top voted questions first, of course.
Yep.
Okay, so you talked about, pre-product market fit or pre-traction and post-traction failure rates. And I think that's and then I want to also unpack your concept of liquidity. But let's start with the failure rate. So you said, you could expect as much as 90% of pre-product market fit. And like, can you just unpack your thinking of failure rates when you make an investment by stage, roughly? Because a lot of people are pulling crap out there, but if you will, and you've actually done a lot of investments. So you have a little.
Well, I made 350 investments in 11 years, and I'm doing approximately 100 a year now with a team of 18. So I went from a scout 11 years ago, making an investment every month, to now having a team and doing 10 investments a month. A lot of those are follow-on financings, but and a lot of them are new ones. We also have an accelerator at my company. So, and we have the largest angel syndicate in the world at the syndicate.com, which is 9,000 members. And we just created a second syndicate called the SaaS Syndicate that has 2,000 members in the first 2 weeks. That's just for SaaS companies. And these are accredited investors. This isn't like Republic or Seed Invest, which are awesome for equity crowdfunding, and they have accredited. This is only accredited that I do. And so we're the largest syndicate in the world. Our median deal size is like 700, 800K, but we've done $2 and $3 million deals. And it's typically because of the allocation we're given. The first deal we ever did was calm.com, put $378,000 into that company when it was worth 4 or 5 million. That company's worth 3 billion now. So we own a 5% of that. It's a $150 million position on $378,000 invested. So we got quite lucky on that first one. Putting all that aside, when we invest, in the book I wrote, Angel, I told new investors the best strategy they could do is to not invest into companies until they have the first couple of customers. Let's call it 5 that you can talk to, and 5 customers that were sourced not from, I used to work at this company, this is my cousin, this is my sorority sister, mom. Because when we do meet with a company and they say we have 5 companies and they give us that logo slide, the logo slide says like our customers. And then we look at it and they're like, yeah, these 5 are in the pipeline. These 5 we met at a party. These 5 are using the software, but none of them are paying us. And we're like, you're using the term customer for pipeline, friends who logged into the software once, and people you met at a party. So, and I explain this in my book as well. Not to plug the book, but this concept is so important that you have to really get it right. You have to understand like 5 customers they earned and that are actually using the product, real customers. So when somebody tells us they have 10 customers, we assume they have 5. When they tell us they have 15, we assume they have 10. We just assume the first 5 to 10 are just complete bullshit. And, they may have logged in once.
Even if they paid?
Now, if they paid, that's different. What you would want to know is if they've paid, that's a great benchmark. And then you get to look at churn, right? So how many people have paid? How many people have unsubscribed? So there's a great punch up, Adeo. You're looking for signals that they are actually using the software, because founders, they won't lie in most cases, but they will present the best possible case. So you're a detective as an investor. Do not trust anything that's told to you. Verify. You can trust, but verify. That's what I train new investors to do. Trust, but verify. They tell you they have customers. You say, how much are they paying? They say they're not paying. And they say, okay, well, you use the term customer. So are they users? They're like, oh yeah, they're on trials. Okay, so they're free users. And they're like, no, they're customers. I'm like, well, okay, we define customers as you have their credit card and they've paid. So let's, for this purpose of this conversation, Mr. Founder, Mrs. Founder, that customers equal paid, trials equal free users. They're users and customers. How many users do you have? Oh, we have 10. Okay, let's talk about how those users are using the product. How many logged in? How many people log in and use the product daily? And they're like, oh, well, we have 72 registrations. And you're like, okay, that's cumulative. How many logged in today? So this idea of being a detective, I tell people it's like being Columbo. Oh, ma'am, you said you went for the pasta on a Sunday night, but they told me Sunday night's the chicken palm night at Antonio's restaurant. And you're basically, that's my Columbo impersonation. If you don't know who Columbo is, it was greatest bumbling detective ever. I just ask very basic questions. To your original point, how many of these fail? I would say companies that have been actually registered in Delaware and incorporated, and people are working on full-time. Let's define that as a company. We'll take all projects out of it. So they've registered in Delaware. They spent the money, $1,000.
It's an actual company.
Actual company, not a project, because you will meet a lot of projects or people who have an idea. So I'm taking all of that out. You have 1 or more people working full-time at a company that has been incorporated, a full-time employee on it. Of those, I'd say, maybe 80 or 90% of those companies will fail and return $0. Now, if we then make the definition, they got to 5 to 10 customers, people paying or using the product daily as a free product, actual folks using or paying for the product. Of those,
not friends and family.
Not friends and family. You actually say to the person, and this is what we do in our meetings, they say, we have 7 customers. You tell us your 7 customers. If they can't tell you the 7 customers, that's a bit of a tell. They pull up the 7 customers, say, okay, can you tell me how you sourced each one? Now, when you say, how did you source each one? If they don't know how they source their customers, well, that's problematic because they're not even tracking where their customers came from. And if they say, well, we got these 4 when we had this, when I tweeted to my friends, and we got these 3 because we emailed 100 people cold and 3 people did it. And we got these 2 when we were on Product Hunt. Great. You're sourcing. Now you're really having a really good conversation with a founder. And I'm looking to have that ping pong like conversation with the founder, the tennis one. We're evolving. Hey, how many customers you have? Bonk. We have 7. Great. Bonk. How did you source the first 7? Boom, back and forth, a little volley. And you can kind of you've had this probably happen, Adeo, where you're getting into a rhythm with the founder. You're asking questions. They're returning them nice and short, crisp answers. If they start bullshitting and telling you about market size, the vision, their last 3 companies that failed, their childhood, you probably got a founder who can't answer the question you have. And they're probably in those earlier groups. They have a project, they have an idea. They don't know what they're doing. They haven't actually gotten to where they're presenting themselves as. So you really got to unpack all that and understand it. Now, that group of people, I'd say 60, 70% go to 0. Now you get to companies that hit 25, 50, 100K in revenue. That's where I would like to see early investors investing. When they get to that 10,000 to 100,000 a month in revenue. Why? Because you actually have some reality that you can talk about. And the reason I'm saying this is, if you're a new investor, you don't have the gut that I have or Adeo has to kind of feel and say, okay, I'm reading into this, that this person could be successful. I'm using my intuition. And what I'll tell you is, people tell me I'm one of the best pickers ever. And I look at it and I say, I think it's a function of my network. And yeah, maybe I'm slightly better than other people, but you want to have more instead of qualitative stuff, you want to have quantitative stuff to make these decisions.
Especially in the beginning. And so why would you, if you had an unlimited supply of startups to invest in as a new investor, focus on companies that are just telling you their ideas or showing you mock-ups? You're probably not qualified to assess those. That's very hard. That would be like somebody talking to a basketball prospect who has never played in any league, high school, college, anything, and just saying, I watched them play at the YMCA. I'm going to give them a contract with the Knicks or the Lakers. You probably want to watch them in college, have them run through a workout and actually look at their highlight reel. Well, that highlight reel and watching them work out, that's actually talking to their customers, but that takes work. And people are lazy, including investors, and they don't do diligence and they don't talk to customers. They don't look at metrics. And that's what basically will define who's a successful investor and who's not. The ones who put the work in, who do the work to figure out which of these companies are real. Be the detective, right? So at that revenue level, what do you think the failure rate is roughly from your experience? It obviously goes down.
Yeah, it goes down massively. Now, we'll redefine failure here. Failure, as I defined it previously, was it goes to 0.
Right.
A lot of these companies will not go to 0, but they'll also return 0. They'll go sideways. They'll become zombie companies. So often we'll see a company get to 25, 50K in revenue, even 100. They're making $1 million a year, and they never triple that number. So what we're looking for in venture is triple, 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 double, 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 something like that. Or maybe even 4, 4, 3, 3, 3, 2, 2, 2. In other words, you had 100K in revenue in 2020. You have 400K. You 4x'd it in 2021. You 4x'd it again to 1.6 million or tripled it to 1.2 million. That's the velocity you're looking for in growth. And if you see that kind of velocity in growth, which basically means you're growing double digits month over month or low single digits week over week. And that's what we ask founders to explain to us and show us the graphs. And we tell them we understand it's going to be spiky. Of course, it's early days. But can you show us your revenue by week, month, and quarter? And put it in a spreadsheet and just give it to us. And we'll look at it. And founders who can do that and give us that data quickly, that's a tell. They're already recording that data. People who are not, that means they're like not even, they don't even know their shooting percentage if we're using the basketball analogy. They're just chucking the ball up. They're not even thinking about how often do I hit a 3? Or should I be, doing layups or driving the basketball or dunking or passing? They're not really even considered. So we're looking for considered, thoughtful founders who are tracking their metrics. That's a big tell. And anybody can tell you about ideas. Anybody can talk to you about product till the cows come home. What we're looking for is really the tightly defined flywheel of team, product, customer. And all startups, and this is something I've been working on in my training, my team, is just really getting dialed into what's essential: team, product, customers. And that's the flywheel of Silicon Valley, of startups. You build a team, they build a product, the product hits reality, rubber meets the road with customers. The customers engage that product and generate revenue, which then allows you to invest in your team. If you invest in your team, either giving them raises or hiring more people, or getting them more resources, then that will make a better product. That product then will get more customers. The customers will spread the word about that product because it's so exceptional, which then gets you more revenue, which lets you build the team. And that flywheel becomes unstoppable in a company like Airbnb, Uber, Tesla, SpaceX, Google, Facebook. Just pick a company. They get to hire the best people who make the best products, who delight customers more. And really, that's what startups are about. And you, as an investor, if you're just looking at the team, yeah, there are signs that you can see a great team, but when they show you their product, right, you learn a lot more. Because I've had people tell me they make the best steak in the world, and then the steak never arrives. The product is never delivered. And they told me that it's the best steak I'll ever eat, but the product never gets released. And then they tell me it's the best steak ever, and customers love it, but then I never meet a customer. They built the steak is sitting there on the table, there's no customers eating it. What you're really looking for is the person who says they can make the steak, you tasted the steak, and you talked to customers who ate the steak and paid for it, right? So just think about that flywheel. And there are talkers and there are walkers. There are doers, and then there's everybody else.
So I'm taking notes to keep. So back to that revenue level of 10 to 100K, are you looking at roughly a 50% don't return? So you said return zero, don't go to zero. So 50%.
Maybe you're going from 10% return capital to 20% return capital to 30 or 40% return capital. And that's why the valuations go up and your multiple on your capital invested goes down. As it becomes a sure thing, as the odds of it failing go down and the odds of it succeeding go up, the valuation goes up and the return goes down. When I invested in this company, they had not launched yet. They had 2 taxis in San Francisco that 3 or 4 of us were time sharing. The original idea for Uber was like a fractional ownership of a home or a jet. And the idea would be 6 of us, 8 of us would get together, hire a driver, and then we'd share it. And if you happen to be going to the airport, I would have to wait, but that was okay because that wouldn't happen that often. And if the cab drove you from San Francisco to Palo Alto, that's fine. You just take a taxi or whatever, but we would share a driver, a fractional driver. And then if it got too busy, we'll figure it out then. It obviously then moved from fractional to just, sharing a pool of drivers. But I did make that bet before they launched. Robinhood, I made that bet before we launched. Famously, you were with me when we were at Antonio's Nut House. That $50,000 check resulted in $20 million in returns. So thank you, Adeo, for inviting me out to Antonio's. I owe you a beer. Or
Antonio's is not the place you would expect to meet the next.
Or I owe you $19,950,000. Either one, you pick a beer.
It's all good. What goes around comes around.
It is true, isn't it? Yeah. So that's what I would say it equals. And that's why people like Tiger Global or other public market investors are saying, you know what? We invest in these things when they go public. We invest in them right before with a bridge financing. Let's go down to the seed round. Oh, you know what? Well, let's do the B, and we'll just overpay for the B, assuming that people who did the seed and the Series A and the accelerator that hosted them, that they figured this all out, and we'll just pay double of what everybody else pays, and we'll do no diligence or very little diligence and send a huge check, which is a really awesome for founders, disturbing for reality.
Yeah, and I want to talk about that. I want to unpack that. By the way, I'm unpacking the little piece of paper where you did in Austin, which showed the inverted. So I followed your advice, and VC Lab is in many ways the result of that. So, but back to so Jason and I give each other advice here and there, and then occasionally
sometimes it's correct.
Hopefully. So I want to go back to the craziness you're alluding to in the market, because you kind of were insinuating that valuations are crazy, but people are still making money at these crazy valuations. Not like people are not making money, because the craziness continues all the way through to SPACs and now IPOs and other things. So it's not like there's an end. It's not like crazy valuations only at the Series A and nothing at Series B. There's crazy valuations all the way through IPOs. I mean, there's $1 trillion companies right now.
Yeah,
Did you
so
ever
there
think
there
you'd
are
see a day
6.
of trillion-dollar companies?
There are 6 of them, yes, I think 5 or 6 of them. So I would not equate the outliers with the norm. That's what's happening right now. And so I think that's a very dangerous thing. I had a company at one point tell me, I was like, explain to me your $15 million valuation. This is like 8, 9 years ago coming out of YC. And I was like, I want to invest in the company, but 15 million on a note you haven't even launched yet. I was like, Uber, Thumbtack, and DataStax were 15 million. And the person said, I said Uber and Thumbtack were $9 million. And the person said, well, this is only 50% more. And I said, no, you didn't let me finish the sentence. They were 9 million combined. You're asking for what Calm, Uber, and Thumbtack were worth combined. And those founders had done more in those companies and previously than you have. So how does this valuation make sense? And that company wound up failing, and I didn't invest, and I didn't invest based on valuation. So to your point, it's like a crazy party right now, and people are showing up at 4 a.m. thinking this party is going to go forever. Eventually, the sun's coming up, and there will be a reckoning. And so, yeah, maybe you showed up at 4:35. I can tell you the police are coming, and the sun's going to come up, and the party's going to end at some point. I don't know when it is. Nobody knows. So if you want to keep dancing and you want to pay this high price, you might be the person who pays the bouncer $100 to come into the party, and then it ends 5 minutes later, and you feel like an idiot. So there are higher valuations and exits happening, but if you look at the SPACs, they've been largely, I would say the majority of them now are trading below even their SPAC prices in some instances. They've got absolutely clobbered. So these retail investors, these crypto investors, these day traders are now starting to think about reality in some cases. I think they're going to start thinking about reality soon when they realize that they may have bought a JPEG for $1 million or $200,000 that has actually no essential value in the real world. And there's nobody else to buy it from them. This doesn't mean that crypto isn't real technology or NFTs aren't a really cool thing. It just means the asset bubble is very real, and eventually all companies are going to be valued on their earnings. And somebody said very famously, like the stock market is a voting mechanism and then eventually a weighing machine. People are voting right now for a lot of different technologies, but eventually they're going to weigh the businesses, and the weight of the business is how much free cash flow, how much earnings, in other words, how much money do they throw off. And Apple is now being judged that way. Microsoft is being judged that way. Tesla will soon be judged that way. They're actually throwing off profits. Uber, Airbnb are starting, and Lyft even today are, like Lyft actually showed a profit. I think Uber's reportedly showing a profit. Now those companies are facing that reality, and a lot of those stocks went sideways for a long time until, they throw off profits. So I don't think that the world will exist in which people will suspend disbelief forever.
So that I like this outlier norm confusion, right? Because people are saying, like, look at all these outliers, they're growing like this. You could be an outlier too. But
I wouldn't build a portfolio based on outliers. Like when I go to work every day, I don't say, okay, well, this company is going to be another Uber or Robinhood or Calm for me. I don't say that. I say, let's look at the team. Let's look at the product. Let's talk to the customers. And I focus on process. The problem right now is you have people who have forgotten about process, and they're just looking at outliers or looking at shiny new objects, and they're suspending disbelief, and they're writing checks at any valuation and hoping for the best. Some of them will get lucky. If you keep placing bets, you might hit one of them, right? But if you just keep walking up to roulette tables and putting, $1 million on, 21 red, like, you're not going to win the majority of those bets. You need to have a process here. And I think that's the best thing I can tell you is to focus on your process, and the outcomes will take care of themselves. That's all I do all day long. I try to stay humble. I don't look at the previous victories. I look at each company with fresh eyes. We have a dialogue internally in the company. We do diligence harder now than we ever have. And I say, what did the customer say? Tell me about the 3 customer conversations. Tell me about the team. Who's their next 3 hires? What are they missing on the team? And tell me about the quality of the revenue, which is a whole nother discussion. But, you really have to focus on process and not worry about outcomes, because the outcomes are a function of process. You don't have control over outcomes. I don't have control over, Robinhood's direct listing or Uber's, IPO. or secondary shares. Like people keep trying to buy my secondary shares in Grin, and some other companies we own. I don't have control over if people want to buy secondary. If they do, I make that decision.
Have you sold any secondaries?
All the time. Yeah. All the
Yeah,
time.
it's kind of crazy how liquid, but that's part of what I was saying. There's like a lot of liquidity at every level, not just
Well,
getting to
it's
the
not like
IPO
I can
back.
say, it's not like I can say for every company, I want to sell 10% as an early stage investor. I would say one
No,
times
but
out of
the
10,
best ones.
I would say even with the best ones, it's 1 out of 5, 1 out of 10 times they're raising new money at a late stage valuation. There'll be an opportunity to do secondary. Since those opportunities are still rare, I will sell 10% of our position, or 20%, something in that range, if we're up 50x, 100x, to lock in wins for my LPs, for my investors, because we don't know when the liquidity will emerge and when the IPO will happen, or if this whole thing will collapse. So the way I look at it is, this is like being in a poker game, which you're not allowed to squirrel money. You're not allowed to take money off the table in a poker game. You either leave with all your chips, and then you have to go sit back down with chips. So if they told you in a poker game and you were running amazing, and you bought in for 10,000, you have 100,000 now, hey, you could take 10,000 off the table. Poker players would do that all the time. Okay, I'm going to bank my original investment. Great. Oh, I can take off $20,000 of my $200,000 win. Great. I've locked in a 2x. I still have 180,000 on the table. And I've been doing that quite regularly. Now, we sold 10% of our composition at $250 million. Maybe 4 years after we made the investment, I locked in a huge win for those investors who invested at 5 million, or like 40x or something. And I emailed them like, hey, here's your, or maybe it was 30x or something, because it was some dilution. I sent them their money. And one person was like, this is the greatest angel investment I've ever had. I made 30 times my money. I said, yeah, you still have 90% of your shares. And they said, I don't understand. And I said, we sold only 10% of our position. He goes, what? That would mean I have 10 times this amount? It's 300x return or whatever. It's like, yeah, that's what I'm telling you. Like, we just sold 10% or whatever. So actually we sold 10%. It was up 30x. So they got like a 3x on their money. And they were like, I can't believe in 4 years, I got 3 times my money back. This is better than the stock market. It's like, you still have 90% of your shares. Then it hit 2 billion, or no, I'm sorry, it hit 1 billion. I sold another 10%. I sent them all a massive amount of money. We still have 80% of our position. Now it's 3 billion. Do I feel bad about not getting that 10x on the first 10? No, of course not. That money was returned to investors. They could have put it into other assets. And so I believe in slowly pairing your position. I was able to sell some of my Uber before it got public in a private transaction, small amount of it. Then I was able to sell some to Masayoshi-san right before the IPO, and then I held the rest. And, that allowed me to buy homes, to pay down debt or, mortgages, and to have cash in the bank that I could deploy in other startups. So I think that that's a wise philosophy. Now, some people believe be all in, ride your winners. I think you can ride your winners 80, 70, 80% and still pair off if you have other opportunities to invest and keep that evergreen fund going. So I like this idea of an evergreen fund.
Oh boy, I was going to ask about that. So okay. All right. Do we want to open that?
Sure. Yeah.
So we got
evergreen.
lots of questions in. Why don't we do
Yeah.
this? Do a little evergreen talk, upvote questions. So go to Q&A, upvote questions you like, because we got a lot of questions, and we'll get to them in 1 sec. But let's talk about this Sequoia thing, evergreen. I know lots of evergreen funds. They're so hard to do. So, all right, share your thoughts on.
Well, I mean, on a personal basis, I've been lucky enough to be in a couple of the top venture firms in the world, and I'm in about 20 venture
Are
firms.
you allowed to say if you're in Sequoia or not?
Well, I was the first Sequoia scout, so I think that would be, something that people could rightfully assume. I'm also in Founders Fund through some of our mutual friends. And so I'm in a handful of funds. I'm not doing any other funds right now because I'm over allocated, but I will get a big win. And then I'm like, oh, I can put it into other people who are making bets in venture. And then I buy houses and put some money into real estate. So I can have some security there, and then index funds that track the public markets with Wealthfront. And so I try to balance out my portfolio, as it were.
Let's go back to the evergreen funds, though.
Yeah. So, I mean, Sequoia is in a unique position with the Sequoia Fund in that they are the greatest venture capital fund of all time. They have decade-long investments with the number with each of the top endowments in the world and nonprofits like Ford Foundation, which they're very public about, et cetera. So those folks are saying, hey, if you held your Apple, Google, Square, Facebook from the WhatsApp transaction, Google in a fund, you would have $1 trillion fund out there, or $500 billion fund. And then that could fund future investments. Why would we ever sell it and take the tax hit? And if you're at Ford Foundation or Harvard or MIT, or I don't know exactly who their LPs are, but if you were in one of those endowments or retirement funds, would you want Sequoia on the board of these companies since inception to help you make the decision of when to liquidate? Or would you want to make that decision as somebody in Boston who's not on the board of Google, who's not on the board of Square? So Ruloff, both was a friend of mine who made me the first Sequoia Scout. He's on the board of Square. I think Square went public at $15 or $20, and now it's worth 250. He knew the company was on a tear. If they had distributed those shares at $25 or $15 or $20, whatever, knowing what he knows as a board member, there was another 20x left in it, and maybe there's another 4x after that, which means 80x. If you look at Google went public, it's worth tens of billions of dollars. Now it's worth trillions of dollars. Apple worth trillions of dollars. You would want to hold those positions. I don't think every venture firm can do that, but certainly the top 5 can. And so when I say evergreen for me, I'm 50 years old. I'm going to invest for 10 more years and try to do 100 companies a year for 10 more years. That'll put me at about 1,500 investments, and that's probably going to be a good time for me to pass the torch. But thinking about having an evergreen fund is very interesting to me. I've actually been looking at these DAOs and some of these other structures around coins and stuff like that, where I think that there is a possibility in the next 5 years that somebody like me could say, here's everything I own. Here's my plan for investing. You got a bunch of crypto funny money. Put the crypto funny money in this DAO. I'll make the decisions of what to invest in. You make the decision if you want to sell it, and then let that be freely tradable in crypto. Then people who wanted to invest with me would never have to meet me. They could just say, Jason seems smart. I watch his podcasts. I see his investment history. I see his team. Here's $100 million in Bitcoin. Mazel tov, I've got $1 billion. Go invest it in startups. In the real world, I would like to get out of imaginary money and be in real companies. And then the DAO could just trade. And if I have a bad year, people could sell off. I have a good year, people could buy in. And there would just be this floating cloud of liquidity somewhere, with $100 billion in it, $1 trillion and whatever it is. And my job continues as it is. And everybody else's job is to just buy into that liquidity pool or not.
Okay. So many good questions, but let me so you said like hand the reins over and you talked 10 more years. Now you talked about the DAO. And when you put those 3 circles together, there is an overlap in the middle, like some sort of Venn diagram, but it's not super obvious, right? Because 10 years means you're actually going to be kind of tracking the companies for 20 to 30 years from today, potentially.
Correct. And that's why a DAO or some sort of organizing.
Okay.
Yeah.
Those are 2 of them. Now let's talk about handoff. So the DAO allows you to do 10 more years of investing, tracking it for longer without so much active involvement. Because you can rely on your LPs in this decentralized system to help manage. Who are you? Look, venture's kind of in trouble, traditional venture, because a lot of the funds didn't do a good job of training the next generation.
Probably true.
A success story of training the next generation. Kleiner, on the other hand, hasn't had a similar success story. So
they had to recruit Mamoon. They tried to get Chamath to take over Kleiner. Chamath didn't do it, and then Chamath's partner Mamoon did it. So, I do not.
But that's that they had to bring in from the outside because
they did. Yeah, I mean, listen,
from the inside.
That's the dynamics of funds are very complicated because there's so much money at stake, and the funds got so large, and the fees got so high. So I think the fee structure distorted a lot of things. You raise $1 billion fund, you get 2% of that a year. It's $20 million. You got 4 or 5 partners. They're each getting $3 or $4 million in cash plus the returns. Then you do 3 funds every 10 years, 4 funds every 10 years. Partners start making 10 million fees a year. and then they don't invest it. They have somebody like, Andreessen Horowitz comes along and they say, okay, yeah, let's just hire a mountain of people to do HR and marketing, which great founders don't really want some venture firm doing their marketing or HR for them. So it's kind of weird, but they did up the ante in how they distributed those fees. So yeah, things got distorted. What I've done is I just say to my team, hire me researchers, hire me associates, I'll train them. I put them on a very aggressive schedule to share carry, but I'm a solo act. I'm a solo GP. Don't want any partners. Want to have a bunch of managing directors, principals, associates, et cetera, for the next 10 years. No partners.
And then how do you hand that off?
So my thesis is, the syndicate.com is growing so nicely that now we have 3 syndicates. Jason's syndicate, the original one, where I make the decisions. The all-in syndicate with Chamath, myself, and Freeberg. Sachs opted out because he's got his own fund. We make the decisions. Then there's the syndicate, the SaaS syndicate, where the members vote with their dollars. If 500K shows up, then we fire off the deal. So it's sort of like they vote. We present the deals. They decide if they want to invest. If it hits the hurdle, we do it. So you could then see, maybe I would do a marketplace syndicate or a fintech one or a crypto one or an Austin-based one.
So more decentralized, so it can run itself.
Exactly.
Without having
which is what AngelList did, but AngelList relied on people like me. And then why would I stay at AngelList and give them any amount of my carry? So what I'm building is just a platform that I control. And that platform.
I like Naval, but AngelList is just fucked up. Like, what happened?
No, I mean, I think it's one of the greatest success stories and one of the most innovative companies ever in venture. Probably one of the 3 biggest innovations that's ever happened, along with Y Combinator. I think Naval doesn't go to work every day. He's a philosopher who made enough money that he doesn't have to go to work. So when the founder is not there every day, you can have a big drift. They can do product hunt, they can do jobs, and people start making decisions. They do venture funds, they do rolling funds, they do SPVs. So I think there was probably a little bit of drifting and trying a lot of different things out as there's different management. And a lot of those were successful, and a moderate success or success in a company then can pull the company in multiple directions. I suspect that's what happened. And then the golden goose was, of course, people like me or Kevin Rose or Tim Ferriss doing syndicates.
Right.
And they deprecated that, which was so dumb. Like they should have fought to keep people like me in the building. And I told them, like, listen, I'll stay here if I'm on the homepage. I literally gave them a list of my demands, and they were like, we're not going to negotiating with you. I'm like, why are you socialists? Like, they're like, we're socialists at AngelList, but we're entrepreneurs in the real world. And I was like, great, I'm Kevin Durant. I'm LeBron James. I want the best deal. And if you want me to send people to angel.co/Jason instead of the syndicate.com, then you need to give me the best deal. I want to be on the homepage, forever as the #1 syndicate. And if I'm not on the homepage, then I'm not going to put my deals there. And I want 100% of my carry. I'll give you 0% of my carry, but you get to have me on the homepage, bringing everybody from This Week in Startups and TV shows and CNBC hits to AngelList. And then I want to own, 2% of AngelList. And they were like, I owned whatever, 10 bips in AngelList as like a little advisor. And they were like, we want to give everybody the same deal. I was like, all right, well, peace out. And I'm starting the syndicate. Now I own 100% of the syndicate. It was the best move I ever made, because the syndicate is, doing.
Well, it would have been great for them, because then they have the funds and everything. They could still come in your deals. It's not like they're not getting in your deals because they have a fund.
I think Naval, as Naval told me, and we're friends, like, I hate negotiating, and I really hate negotiating with you. You're too aggressive. And he's right, I am. But, if you want LeBron James or Kevin Durant on your team, and that's me, I'm the #1 angel investor, most active one at least. Right now, and we can debate if I'm the best or not. Maybe it's Bill Lee, maybe it's Ron Conway, maybe it's Chris Sacca. We'll see at the end of the day, but I'm definitely Mount Rushmore top 10 or top 5. And so I would have fought to keep me in the loop, but they didn't want to have, this crazy barbarian running around in their kingdom swinging a battle axe, which I understand. And I respect them for saying, basically kicking me off they basically kicked me off the platform because they were like, we just don't want you here. And I was like, wow. And so I was like, well, you know what? If you don't want me at the dinner party, I'm hosting my own. And then 9,000 people signed up after I wrote my book. And I told them, I was like, I'll put in the book, angel.co/Jason on the first page, or I can just not do that. and they chose to let me go. So it's like
Honestly, though, I think it was the best decision for you.
Absolutely. It was like the Mike Arrington fight I had. It was like, I was partners with Arrington on TechCrunch 50. We got in a big fight. And then I did Launch Festival, and then I started my own funds, and then I did
I
Angel.
was
So
there.
yeah, it's like, sometimes in life, like, and where's Arrington? Like, oof, like he's a non-player in the industry anymore, with a sort
He
of
lives on an
reputation.
island near Seattle.
So, anyway, he goes off into obscurity, and then I go off to AngelList and do my own event. And then AngelList is like, yeah, we don't want to give you the best deal. And then I start the syndicate. So both of those forks in my path resulted in me being independent and me being self-aware enough to say, you know what? I'm a solo act. I am like, some people are in a band and some people are solo acts. Like I'm a solo act, like Dylan, microphone, harmonica, guitar, spotlight.
It's they're pros and cons. We have
I have a
lot of
backup
solo
band, don't get me wrong,
GPs.
but I'm a solo
Yeah.
act.
We got a lot of teams, and like, right now at VC Lab, I have a kind of a strong team, and it's amazing.
I suspect, some people are great in a band, and there are great bands in the world: Led Zeppelin, Rolling Stones, the Beatles. And, some people work better in a band and some people work as a solo act. I don't want to debate an investment with anybody.
Yeah.
If I want to invest in Uber or Calm, the investment is happening. And if I don't want to invest in a company because I get a bad feeling, it's not happening.
So I'll tell you a funny thing though. I've been interviewing some great VCs like Steve Jurvetson and others. And one thing they all kind of, Jed Katz, they've said it, actually, they have a process. I'll just throw it out for your benefit. Where they call it, Jed calls it the pound on the table rule. So if you're pounding on the table, yes, or you're pounding on the table, no, you can actually outweigh any other decision. And even if other people disagree, you're just going to do the deal. And then there's a limit to how many you can do a year. And Steve had the same process at his new firm, Future Ventures. FYI. All right. Hey, we got tons of questions. Let's get into these questions. Guys, upvote, upvote, upvote. So
I don't have a table, by the way. There is no table. We're not sitting down and having a debate about this bullshit. Like that's the antithesis. Having to pound the table is the antithesis of early stage investing. I think it's great for later stage, but because there's so many problems.
Well, there's Series A, correct. There's Series A.
But here's the thing. You can talk yourself out of an investment, and there's more reasons to not invest in a company, Series A and below, than there are reasons to invest. So the logical process will result in you missing an outlier like Tesla, Uber, Airbnb. Those companies looked so bad in the early stages, and there were so many problems with
it. No offense.
Well, Tesla, Uber, Google, the 11th search engine, Facebook, a knockoff.
Sleep on someone else's couch, Airbnb.
All this stuff looks really dumb. It looks really dumb. It looks, the most innovative companies look the worst in the Series A or before stage.
Slack.
It's like, dude, cartoon chat room. Like your chat room is going to be worth $25 billion, and Salesforce is going to make it. Salesforce can make a fucking chat room in 10 minutes. They've got 10,000 developers. They could literally put 10 of them. They could make 10 groups of 10, and in 1 month make 10 clones of Slack, and they pay 25 billion for it. So what's going on there? Brand matters. Intangibles matter. Teams.
All right, let's get to some questions.
Questions.
Okay, I agree. Okay, you can, and so it's a lot more in the earlier stage. Okay, so first question from Lauren. She's in the current VC Lab cohort, so she's saying a lot of emerging market focused funds are here in VC Lab. What is your outlook on the role of US-based venture capital playing in emerging markets like Africa, et cetera?
I'm getting an amazing amount of emails from Africa in the last 2 years. So obviously something is happening in Africa in terms of startup and entrepreneurship and culture. There's a lot of countries there that have over 50 million folks living in the country, which is great. And my belief is that in order for you to be an exceptional VC in a market, an international market, you need to have boots on the ground. You need to understand the culture. You need to speak the language. So I love Japan. For me to invest in Japan or South Korea, both countries I love to visit. I didn't grow up there. I don't know the culture there. I don't have a team there. I don't speak the language. I can't look at the product. Early stage investing, it's just not going to work. I could draft off of other people, but then I'm just an LP. So what's the point? So I think you need, and this is one of the great things about your program, Adeo, is you need to have boots on the ground. You need to speak the language. You need to understand the culture. And if you're an entrepreneur in a country in Africa, and I'm not sure which ones are the most, I don't even know the populations of each country in Africa. I could start to tell you about Europe, et cetera, but there's only so much a human being can keep in their head. And to understand more than 2 or 3 countries and their cultures, their language is really hard for any single individual.
Their
And
laws, right? Their investment
regulations,
laws.
great point. Like I understand Australia, the US, Canada, the UK, to an extent. But, I don't even understand the Scandinavian companies in Germany, and they're like one step removed. How am I going to operate in China? How am I going to operate in Japan? Your network matters, boots on the ground matters, culture matters. So you do need to have domestic boots on the ground venture firms, which is why Sequoia, as brilliant as they are, said, who are the best people who understand India and China more than we do? Let's let them run the firms there. If that's what Sequoia did, that's what venture firms need to do. That's why when people say, hey, why won't you invest in India or Japan or Africa? It's not that I won't invest there. It's that you don't want me to. You need a VC who understands that market. So I just tell people, we don't have boots on the ground in that market yet. We're not investing there. Now we do in Australia. We do This Week in Startups Australia. My friend Mark Pesci has been doing that podcast for 10 seasons. I did Launch Festival there 2 years. I've been there 5 times, maybe. I understand the market there. I understand the entrepreneurs there. And we're selectively, maybe we've invested in 10 companies in Australia out of our 350. So we're just starting to make inroads in Australia. That's a 5-6 year journey for me. Maybe I can do 1 more country in this career. Maybe I can operate in 3. So just be wise about that. And I think it's why your program's going to do great.
Charles is asking, how will raising capital be different in 5 to 10 years than it is today?
Well, there might be less capital out there if the market crashes and there are too many venture firms. So we could see a boom bust cycle occur where there's too many fish chasing too many deals and getting over their skis. LPs can only handle, so many relationships. So when I went to the big endowments for my second fund, they all said, no, we want to see 3 or 4 funds. We want to see how the first one does. And that's me, I wrote the book with HarperCollins Business on angel investing, and the top funds told me not yet. I'm sorry, the top LPs in some cases told me not yet. Let's get to know each other more. And so, but I don't need them anymore because I can go directly to high net worth individuals who have read my book, who have invested alongside me, and they're becoming my LPs. So I think in the future, what's going to happen is high net worth individuals will want exposure to this category, and they'll become LPs in funds, which yourself, AngelList, myself, Carta, and other folks are enabling. All of those tools, all of that infrastructure is going to allow high net worth individuals to become the LPs of the future, where, of the people who are here, how many of them are going to get Harvard or MIT or CalPERS or Ford Foundation to become LPs in their fund? Those people don't want to write checks less than 50 or 100 million. It's not worth it for Yale to even process a venture fund until they're on their 4th or 5th fund. They have 5 partners and they fit in their mold. So I'm not even trying anymore. When I went out for my 3rd fund, I told MIT and other LPs, like, listen, we've met 5, 6, 7 times. I'm not going to, just respectfully, I don't have the time to go on the road. And I'm filling up my funds by writing 1 email to these 2,000 people. Well, now there's 9,000 people. You know what the problem I have right now is? The 250K, 10 million cap on funds. I can only have 10 million. So for me, if I write an email, I can raise a $25 million fund without ever doing anything else. Yeah. Maybe it's better for me, instead of doing a $250 million fund with the biggest LPs in the world, to every year do a vintage. 2021 fund, $25 million. 2022 fund, $25 million.
Can as a third party hearing you say that, I think that's a beautiful idea. It gives, and then, by the way, as you may know, and well, I know, vintage plays a lot into returns. So if you could do a vintage every year, that would be actually pretty awesome, because then you could really, you would be like indexed to the success of the vintage.
Yeah, so and then never have to go on the road. And I'm also giving people an opportunity to get access to the best deal flow. I believe I have the best deal flow in the world. So
you definitely
do Yale, Harvard, and MIT need any more access than they already have? Probably not. Do they need any more exposure to venture capital than they already have? Probably not. They're in all the mega funds. Do they need to be in business with Jason Calacanis? They don't. They're doing fine. Do I need to be in business with them? I don't. So I can just email my list of these high net worth individuals who are more than happy to put in 500 to 550K to 500,000. And so when I say, hey, if there's a $10 million cap and 250 people, I literally put the cap Adeo at $40,000. You could people, oh, can I put it in 250? I'm like, are you a qualified purchaser? No. If you're a qualified purchaser, you can put in more. If not, literally my last fund, it was a lottery. So I did a lottery and I just said, listen, anybody who wants to put in less, 50,000 or less, put your name in. We're going to do a lottery. And we did a lottery, and most people didn't get in and some people did. So, you know,
that is such a great idea. And like, well, that's what happens if you build a network. And speaking of which, we got a question from Mayur, and I want to get burned through some of these. I want to be sensitive.
Let's do lightning round. Yeah.
All right. Lightning round. This is a bit of a long question, but how does an underrepresented founder, aren't we all, build their network? Do they join an accelerator, pitch more? I started tech in the 90s, but the world is all social now. Do I embrace creating more social content? What are your thoughts there? This is a great question. And, you know, so, you know, Jason and I have as little bias about any of the traditional things of anyone that I've seen. And we've talked about our work to overcome any biases that we have. So I'd love to hear your answer.
Yeah, I mean, listen, newsflash, the world's unfair, bias exists. Okay, so if we just accept that the world is unfair, the starting line is different for different folks. You know, for me as a kid from Brooklyn, I thought like, wow, look at, I'm so far behind the kids who went to Stanford and Harvard and MIT and whose parents were rich and, you know, they went to the Ivy League. And then I looked behind me and I saw a whole nother crowd of people whose starting line was even further behind than mine. So maybe I was middle of the pack as a white kid from Brooklyn whose dad was a bartender, mom was a nurse. So if we just accept those two things, then we can actually just make a plan. And I think making a plan for how you route around that is the most important. Being an advisor to companies and helping them with some skill that you have that's unique in the world is a great way to build your credibility and to get 25 basis, 50 basis points in a company. That's how I did it. I was an advisor to companies and I helped them with marketing, which I was good at, and you know, getting attention and doing introductions. So you have to ask yourself, what skills do you have that are unique in the world? If you don't have unique skills in the world, we'll just go on YouTube and MIT OpenCourseWare and find some skill you're great at: sales, marketing, PR, recruiting, etc. All startups need recruiting. So just the act of being great at recruiting. If I was somebody who was a nobody in the industry and I was starting over, I would just become a recruiter, master recruiting for developers, and then become an advisor who helped with recruiting, and then start a fund based on recruiting, because recruiting is the hardest thing. What's the next hardest thing? Growth. So I would become a growth marketer, have that skill, and then just help startups grow. After I had 10 advisorships of 25 bips each, I'd ask them to introduce me to their VC friends, see if I can get a job at another firm, and then make 10 investments. Now I got 10 advisorships, 10 investments, boom. So you're in a race to be credible. Credibility comes from skills and network. So I think you know the answer, which is, you know, you might not be able to raise the fund right now, but you might be able to be an advisor to 10 companies. And then after you do that, then you might be able to raise a fund. And so boo-hoo, I didn't have any rich friends and rich uncles to fund my fund. So I was an editor and I wrote and I got attention. And then eventually I got the break of being a scout when I was, whatever, 38, 37 or 38 years old. So, you know, it doesn't happen overnight. And if it does happen overnight for some people, you can choose to be bitter about it, or you can choose to just increase your skills, build your skill stack, provide massive value. You're in a race to provide massive value and have massive skills. Focus on that.
Beautiful. Brian's asking, what are your thoughts on investing in clean tech, and especially things that take a few years to really develop prior
a few decades
traction, right? Because there's a bunch of things, like we got a lot of deep tech investors, clean tech. They need something before they have customers, right?
It's basically, you're talking about a multi-decade journey, which is why I think Steve Jurvetson told his LPs it's going to be a 20-year journey, not a 10. And I think his fund is set up for a 20-year cycle or something like that. So I think people are building funds with that in mind, and it's going to be hard. And so, you know, if you choose to do deep tech or you choose to do that, just be aware that you'll have more pain and suffering than if you choose to do things that can get to market in under 12 or 24 months. And then those companies are going to fail at a higher rate. And if they do succeed, maybe they win at a higher rate. So you're choosing to do something really hard, which means you are going in eyes wide open to a very painful existence. And a lot of your companies are never going to get product market fit. So
I'm going to jump around to some of these questions. I think they're really good here. This one's from Barbara. Jason, you have an awesome community. Can you talk about how you build your community? Because I think there's a lot of people here who are like, whoa.
show
Even
up every
I
day.
am like, I would love to learn about.
Just show up every day. You know, it's literally about consistently showing up every day. When we started blogging, Peter Rojas, who I stole from Gizmodo to doing gadgets, I said, what's the secret of blogging? He says, showing up every day. And he would just do 8 to 12 blog posts every day. And he didn't take days off. You know, my career, anytime I was in a city, I'd host a dinner. You were at those dinners in the early days. I was always the host of the party. I had no money, so I would just go to a Mexican or a pizza joint, order 3 pies or order a bunch of quesadillas and nachos and pitchers of sangria and pitchers of beer and pizza. And I'd pick up the check for $200 for 10 people. And the conversation carried us. You know, now I can afford to, you know, get the back room for $5,000 for 10 people and have a different experience. Great. But I just always tried to be the host. And if you do that for a decade or two, you'll do great. And I'm actually going back to my knitting. For This Week in Startups, I started doing meetups again. If you go to thisweekinstartups.com/meetups, I literally said to folks, I want This Week in Startup founders to host founder meetups for founders. And we have 10 cities already that have done it. And we're going to try to get to 100 next year. And it's just 10 to 25 people having breakfast, lunch, or pizza, and founders talking to each other. You can't be a salesperson and come to it. We're going to allow some of our investors to come to those. And small meetups, we just do the work, will build your community. And hosting these kind of events does it as well. Inside.com, the other company I'm running, if you go to inside.com/events, every week we hold 3 or 4 online Zoom events, and between 50 and 5,000 people register for each one. And we're building community, you know, one meetup at a time. And it's like building a fire. It's about kindling and small little sticks and little pieces of kindling that eventually build a roaring fire. People want to, you know, have 300 people. We have 400 people here. You know, Adeo's been doing this for, you know, 2 decades, and he can have 400 people show up. You're not going to have that. You're going to have 4 people show up, 8 people show up. And then the next time you'll have 16, the next time you'll have 50. You just have to show up every day and build your community slowly and smallly, one handshake, one conversation at a time. It's really that easy. Brick by brick, brick by brick, stick by stick. There's no shortcut here.
So sadly, they're probably more than that, but we were 12 minutes late.
It's okay. Listen, is anybody, I mean, the audience is just growing here. Nobody's leaving. So
yeah.
Brick by brick, question by question.
We'll do a few more questions, and then I know Jason will be respectful of your time. So thank you. I'm doing them a little bit out of order, but we'll try to get to the top one. So there are a lot of syndicates on AngelList opening up allocations to deals with well-known investors. What do you think about these? Yeah, you know, back to AngelList. I'd love to hear.
Syndicates are, I think, my preferred method of sharing deals, because it requires everybody to make a decision. And I think great investing is about being able to make decisions with partial information and place bets or not place bets, and then remember why you didn't. So I have my team, we syndicate 2 or 3 deals a week. Sometimes it's pro rata, sometimes they're new deals. I write the opening letter for each one at thesyndicate.com. We've done 220 of them in the last 7 or 8 years. The first 30 were on AngelList. The next 200 were on my platform, thesyndicate.com. And I love writing every week. I write 3 introductory letters. My team writes the deal memo. The founders write the deal memos. My team edits them. We verify the information in them to the best we can and do our diligence process. And then it's up to each investor to say yes or no, and then for how much. So they have to place the bet. I prefer that over funds. Personally, if you want to learn and sharpen your blade, because you get to show up and make a decision. If you want to be an LP and just have exposure, that's fine. You're just trusting, you're picking an allocator for 3 or 4 years to make a series of bets, and you hope to triple your money or beat the stock market. That's fine too. So as an investor, and you can choose to, bet somebody who places the bet, or you can choose to place the bet yourself. I do both myself. Obviously, I'm in 20 venture funds and I make those bets, and I'm not making any more. So please don't ask me to be in your fund. It's going to be a quick no. because I'm over allocated and I already have access to the top funds. There's no reason for me to do emerging fund managers. It's a hard no for me. But because I want to place my own bets and I don't want to place a bet on you. I want to place a bet myself. And so there are different people in the world, and you just have to identify who you are. And as a venture fund, you have to identify, who the LPs are. And I really like syndicates for that reason. I love the idea that you can go back and read my comm, or when I was a scout, we had to write deal memos, short ones. You can read my deal memo for Uber, and it was why should Uber exist? I trolled Ruloff and I wrote, because cabs suck. Because cabs suck. I literally objected to writing deal memos with Ruloff, and he was like, write anything, Jason. And I was like, okay. And I wrote like 2 paragraphs. And then I just thought about it and I was like, what these 2 paragraphs say is cabs suck. And I just wrote, because cabs suck. And when they distributed the 9 figures, they said, to recall the deal memo, Jason wrote, because cabs suck. And it's the greatest, angel investment in the history of the Scouts program by far. Because cabs suck.
Well, that's a great deal memo. Could they all be that simple?
In some cases, yes. I mean, if you're writing a deal memo, it's because Elon is unstoppable. Because Elon's unstoppable, right? Like, really, that's why those companies succeeded, because Elon is resilient. The end.
But to be fair, he doesn't live the happiest life. But he just crushes everything.
Heavy is the head that wears the crown. It's not easy if you want to be a winner. If you want to change the world, there is a price to pay. And so, most people are not willing to pay the price, but everybody wants the fucking reward. And that's the world we live in. A bunch of crybabies who want to win Olympic medals and don't want to get up at 5 a.m. and work out 3 times a day and eat right, but they all want the gold medal. You know what? Too fucking bad.
Well, I know a 40-year-old who went into the Olympics, Paul Vergil.
I remember, yeah.
Yeah, and he had to train super hard, especially when you're 40 to go in the Olympics. All right, look, we're now a little bit over, so we did get an hour in. Let's leave with like a advice that you can share, because I can tell from the questions here, we got a lot of founders who are on their journey, and we've got a lot of investors who are on their journey. And maybe we start with the founders, like, hey, in this world today, here's Jason's best piece of advice to you, and then flip it over to the investor side.
For founders specifically, you don't need to overcomplicate things. Being a great founder is about building a great team that builds a great product that delights customers enough that they use it every day and pay for it in some way. And if you can really focus on that flywheel, you're going to do just fine. If you are focused on speaking at TEDx, if you're focused on getting in the Forbes 30 under 30, 40 under 40, fabulous 50 over 50, whatever the fuck it is, you shouldn't be a founder. Just product, team, customers, obsession, 10, 12, 14 hours a day, 6, 7 days a week. You have to sacrifice. So if you're willing to sacrifice and be the leader and not take days off and not cut corners and stay ridiculously focused for a couple of years on this mission, it may or may not work out for you in the first company, but it will work out for you by the third or fourth. Just statistically, when we did the statistics at the top here, we said, listen, only 10, 20, 30% ever return money. Another way of saying that is, as a founder, if you do 3, 4, 5 companies, you're going to do fine. And if you look at any of the great founders, Elon comes to mind, Travis comes to mind. Travis did Scour, Red Swoosh, Uber. Elon did Zip2 and PayPal, or X, Zip2, X, and then SpaceX, right? Like sometimes it's the third or fourth time up to
Tesla at the same time.
And then Tesla at the same time as an investor, and then eventually becoming the founder, because the founders were so incompetent that the company was literally on fire and he jumped into a burning vehicle and drove it over the finish line for those schmucks who literally lit the car on fire.
Yeah. So the funny story about that, by the way, that Steve told me that, the company was completely out of money and no investor was giving it. And Elon came in and just wrote a $4 million check. And the way Steve describes it, it's not a pier, it's not a bridge. It was like, I don't even know what it was like. He threw $4 million into the fire. But that crazy act encouraged all the other investors to come in and save the business. So it was crazy. All right, so let's switch over to the investor side. Any final advice for investors?
Take your time and invest in real companies for your first 20 investments. In other words, don't try to figure out 0 to 1. Just when they get to 1 and they have the 3 or 4 customers who are real customers they earned, just focus on that group of folks to start. I think that's the best advice I can give you. And you're in a race to provide more value than me. So I would look at all other investors and then say, do I provide more value than Jason Chamath, Ruloff at Sequoia, whatever other investor it is? And it is and you know who told me that was Naval. Naval said the reason we're winning, because we were both doing so well, is because we care the most and we provide the most value. And that was one of the Navalisms. That's, you know, he's really a brilliant guy. And he taught me a lot. I'm very thankful. I'm kind of sad that we're not friends exactly anymore. I thought we were friends and then he kind of ghosted me, I think. So I'm kind of sad about it, I'll be honest. I really like Naval. I wish we hung out more, but I think the negotiation just maybe, you know, made it a little bitter for him. So probably fucked up on my part. And being too hardcore a negotiator and lost that friendship. But, you know, for him, I think it was a race to see who could be the most helpful. And I just wanted to be the most helpful. And that's who you're up against. Can you be more helpful than Naval, myself, Kevin Rose, you know, pick a legendary investor, Ruloff Botha, David Sachs, Chamath, Friedberg, you know, there's just investors out there, Jurvetson, who are going to provide more value than you. And you have to provide more value than us to win the deals long term. And are you available on a Saturday night if a founder's having a nervous breakdown to talk to them for 4 hours? I mean, that's literally my job. Founders calling me from the shower. Had a founder call me from the shower puking because the company was shutting down and they felt so much regret, and their kids are outside in the car with their wife going to dinner, and the founder is puking in the shower in paralysis. I just said, sell the company to Facebook, take their offer, work there for 2 years, get a bunch of RSUs, buy a ski house, and then call me when you have your next idea. 2 years later, the founder called me from his ski house. I invested in the next company. The end. Like, it's not life or death, but you have to be prepared to be available as an investor and out hustle everybody else to the deals, after the deals. And, you know, I still, again, back to process. Every day I wake up and say, how can our firm and how can I be the most helpful? And it turns out doing my podcast and being in a Slack chat room with founders and picking up the phone when they call is the most helpful I can be. So I do that every day. Focus on the process, focus on the journey. Don't worry about the destination. Don't worry about outcomes. Just wake up every day and do your best work. Wake up early, stay up late, work hard, be available to people, be ultimately helpful. And you are in a zero-sum game. And I know that everybody wants to tell you it's a big open, blue sky, blue ocean. It's not. It's zero-sum. There were only so many checks I could get into Uber. And if you were the 21st check, you didn't get in. And if you were the 19th or 20th, it changed your career. I was the 3rd. I watched the 17th, 18th, 19th, 20th check get in, and I watched the 20th and 21st not get in. Those people's careers were not the same as the people who got in that 17th, 18th, and 19th slot. So you got to earn it as an investor and ask yourself and look in the mirror. Why should anybody care about having you on their cap table? And if you can't come up with the answer, we'll get back to work. Get back to work and make sure you can answer that question. I know why people should have me on their cap table, because I can get you in the room with Sequoia or any venture capital firm in the world. I can pick up the phone and talk to any venture capitalist and say, I love this company, and they will take the meeting. I can put you on This Week in Startups, or I can tweet to 450,000 people and I can get you 1,000 customers if your product's good. Can you do that? No. Will you be able to do that in 5 or 10 years? Sure. If you go to work every day and you out hustle me. So make me your target. Put a picture of me on your wall and say, beat that guy.
Well,
Let's go.
maybe in 10 years, you'll hire them to take over.
Well, I mean, I already
the
have my
passive-
team. I have a team right now, and yeah, I'm hiring people from the researcher out of school for 50, 60 grand, associate 60, 70 grand out of school, 2 years experience. I just hire people at, basement salaries with equity and upside and say, prove it, put in 4 or 5 years. And then maybe I'll make you a principal or managing director when you hit 5 years. If you want that path, and I hire the underdogs and hard workers who are not from Harvard or MIT. I mean, I do have one person from Harvard. I don't hold it against her though. She's got a master's. We just make fun of her for having gone to Harvard constantly. she takes it well.
I don't know if that's like something to make fun of. It's not a bad thing.
It's a curse. I mean, it literally is a curse going to those schools, because you then think that you deserve and you're entitled to your success, whereas everybody else thinks, fuck, I got to work hard to beat those people. I think it's being born with privilege and having gone to those schools is more often than not a huge anchor. It's a huge fucking anchor that drags you down because you just think that you should win the race. You think you're entitled to it. I don't think I'm entitled to anything. That's why at 50 years old, I wake up early, I work late, and I say yes when you ask me to speak, because I know I don't have some MIT, Harvard, MBA, Stanford degree to pull out and be like, I went to Stanford, I should get, Stanford as my LP. Stanford doesn't call me to LP my funds. They LP every other Stanford graduate's funds, but they don't LP my funds. So I'm not going to get Stanford as an LP in my funds in all likelihood. I got to go earn it. I got to go get other people to anchor my funds because I'm not part of the club. Great. I'll work twice as hard. I'll prove you wrong. I think that's a better place to be honest. I'm much more comfortable being an outsider. I think it's a much better place to be. And I think a lot of you are outsiders. I'm not, and insiders, being an insider is a burden. That's why I try not to be. Everybody's like, oh my God, what's it like to be an insider? What's it like to know all the famous people? What's it like to sit courtside of the games with the owners of the teams and the, billionaires and this and that? And it's like, you know what? I don't like it as much as being an outsider. I'd much rather just go order 2 pizzas and order a bunch of French fries and chicken fingers at Antonio's Nut House and hang out with the outsiders with you, Adeo, than hang out with the insiders at the Michelin star restaurant or whatever. It's pretty good to be courtside though for the Knicks.
Well, we cross both worlds, which is a beautiful thing. And I think we both do it with a great amount of humility. Jason, I got to tell you, this was so beautiful. And that idea.
I love you, brother. I love you, Adeo.
Yeah, it's
you are my brother forever. I miss you.
Mutual. I miss you too. Let's get together soon.
Yeah, absolutely. I love you.
With the kids,
sincerely, I love you, Adeo. I think you're just, every year you just work harder and come up with new ideas and you give so much back to the community. I think you're really an inspiration, and I think you're underappreciated in your time. And I think that this VC lab thing you came up with is going to be a great success for you. I think just make sure you get equity in every one of these fucking funds. Everybody got to give you a little tributary. You got to give 5% of every fund. This way you kick it upstairs. I want to see you make some bank. You make some bank.
Well, thank you so much.
How much you got? How much are you taking out of all these people who start funds? You get 1% tributary, 2%.
Not so. Okay, I can tell you about it, but you were an inspiration. Okay, so it's all free. Okay, and no. Listen, you said top of the funnel, and I agree, should be free.
Got it.
Okay, so top of the funnel is free. When we move down and see who's the more interesting funds making greater progress, we offer to help them form their entities and all this. And for that, there are fees which include a venture partner position. So
great.
We actually took your literal funnel and so Jason and I discussed a strategy here, and we're following it to a T.
I just want to make sure that you get paid to measure it with the value you're providing. Like, nobody has ever said, I'm going to teach anybody how to create a venture firm and do all the hard lifting with them and help them, push that boulder up the hill. If you're pushing the boulder up the hill, when it gets momentum and goes down the hill and it just crashes into a huge pile of money and the diamond mine breaks open, I would like to see you get a couple of diamonds.
Yes. So correct. But for everyone, it's free. And if for the best ones that want our help, and most do, then we provide
well worth it. Well
Yeah,
worth it.
exactly. So we followed your advice, and for everybody, this was such a beautiful series of advice from Jason. And
Anytime.
I loved your humility, and I love you too, and I miss you, and thank you everybody for tuning in. Thank you, Jason. Have a
If
beautiful
you
day.
and everybody who always asks me like, hey, how can we help you, JCal? There's only two things you can do. One, go buy my book, Angel, write a nice review. And number two, you can listen to my podcast This Week in Startups or All In and write a review on iTunes. And the reason I asked you to do those two things is I think you'll get value from both the podcasts and the book. And every time you write a review of either of those things, the signal goes up and more people find out about it. And I put so much work into those things. I'm just trying to get more people to know I'm doing it. Because literally, even at this point, year 11 of doing my podcast, I meet people in the industry and they're like, what do you do? I'm like, well, I do a podcast. And they're like, what's the name of it? And I'm like, This Week in Startups. They're like, oh, I never heard of it. And like literally more people haven't heard about the podcast, even though millions of people watch it a month that have heard about it. And I do it 5 days a fucking week. So I just want people to know it's there as a resource. So those
All
are the
In
two
is
things you can do for
amazing.
me. Yes,
This
it's doing
Week in
great.
Startups is amazing. The
Yes.
book is amazing. Actually,
Thank
you know, I will say the for anyone, even a VC, even though it's called Angel, all the stuff you do about prepping for a meeting, treating people in the meeting, all
Yes.
that is universally applicable to every investor. Every venture investor should read it.
There's a reason I put timeless advice on it, because it is kind of timeless and there's a lot of battle scars there. And I'm writing my next book right now. So
yeah, and you talk about treating people. It's, you know, if everyone followed half the advice in the book, most of the problems in venture would go away.
I think that's part of why I wrote it, is just to increase the empathy level on both sides of the table here. And a lot of founders
give people like stupid tricks to do
Yes.
that, like, and ways to be empathetic that anyone can follow. So
Yes.
yeah, I strongly
meant to be
recommend.
very, very tactical and strategic, you know, and I kind of go from tactical to strategic in the book, and the next book is going to be similar. All right.
I can't wait to see it. All right, Jason.
See you soon.
Big hug.
Big hug. Bye-bye, everybody. Good luck.